Good day, fellow investors. We have 4 scenarios to discuss on what can happen going forward for the stock market. We'll start with the starting position, the 3 most predicted scenarios, and then I'll give you also a bonus scenario that no one is thinking about now. But let's start with the market's 2025 prediction from 4 months ago. We did this video and everyone was predicting 10 to 15% S&P 500 growth based on great booming economies, AI, margins, everything. That suddenly changed as now everyone is rushing to cut targets, even down to 5,600 for Evercore. So as stocks are going lower, they will always keep their targets 10% above the line because analysts are simply like that. They cannot accept volatility, things changing. They're always having these linear models. And their linear models are still predicting this has to be adjusted. 50% earnings growth going forward over the next 2 years. Huge AI hyperscaler investments that will increase the profit, will increase profit margins to record highs for S&P 500 companies. All still looks great. However, that hasn't yet been adjusted, and therefore the P/E ratio went from very high levels to still very high levels, but already 20% lower. However, my intrinsic value calculation for the S&P 500 long-term risk and reward, if you want a 10% return from stocks, is 3,000 points at this moment, and I stick to that. So we still have some room to go. However, this week we have witnessed a nice change. This week and everyone was in the red. And over the last month and a half, the market, as I'm filming this, is 17% down. Maybe it will be up today. You never know with the crazy things that are going. But we have to understand this current situation, that this is still very, very expensive. The market is extremely expensive from an investment perspective. The Shiller P ratio that takes into account 10-year average cycle valuations is still at 31. Compare that to historical levels. Only once was it higher during the dot-com bubble. It peaked somewhere there during 1929, and it was also relatively high in 1965. Do I have to tell you what happened after 1929, 1965, 1999, and February 2025. This is the S&P 500 adjusted for inflation on a logarithmic scale. So it was 584 points in 1929. Fast forward how many years? 20 years. It was 60% lower. 60% lower. This is what happens when you buy stocks at high prices. 1968, 69, fast forward to 1982, still 60% lower. 2,700 points adjusted for inflation, keep in mind, still 60% lower. 2025, 6,000 points adjusted for inflation 10 years from now, still 50-60% lower. Of course, that's just my prediction, but I'm just telling you that if you are paying such a high price for stocks, don't expect miraculous returns. Yes, stocks on average returned 10%, but that was on a P ratio of 16, not 30, not double the average. And if you buy here when P ratios are low, then you achieve great returns. That is the situation. And yes, there are bubbles, there is free money, there has been Fed puts. You have been given money sitting on your couch a few years ago to gamble with the stock market. Now that has to revert to the mean. Government debt, biting, interest payments, everything reverts sooner or later. There is no free lunch when it comes to markets or economies. And now we have to discuss the scenarios. Let's say scenario, everything is managed, the Fed's cuts a little bit, there is a little bit of exuberance, there is a soft landing, there is no recession thanks on tariffs, there are some deals made, good news, this and that, and stocks stay flat in the range of where we are now. And you can see immediately on Monday the stock market at the moment went up 6% because people were talking about tariff pauses or the Fed cutting 5 times this year. So a week ago there was 2 cuts expected from the Fed to 3, then we went to 4, then back 5, then back to 4, and now we are back to 125 basis points, 5 cuts of 25 basis points. So that is now the projection that if the Fed cuts, more money, more activity, things are getting better. However, we have to see whether that will really be like that, whether the Fed will be able to cut 5 times. If not, because of inflation and tariffs, if they don't cut, then it will be ugly. Maybe 20% down, maybe 15% up. Let's say it will be volatile, and the government and everyone will likely try to manage things, consumer confidence, things like that, to just balance things out. Plus, globally, everyone is talking about new stimulus, especially with lower prices globally, not in the US. Others can print money, give lower interest rates, so stimulate economies. So the markets might be flat, as 40% of the S&P 500 is still global revenues. Compared to going into a recession, that would certainly impact markets. And also, recession would be negative for sources of financing for the government, increasing spending here, unemployment benefits, things like that. And we'll see, maybe tariffs help this, so lower interest payments, lower this, but that is still this mild scenario, everything is okay. I find it unlikely, especially with listening to Trump and his firmness on tariffs, on us from Europe looting, pillaging the United States. So it's not like now the world, and we have seen also our European Commissioner discussing how Europe, yes, will try to make deals with the US, okay, but will also focus on 83% of the global economy that is not US. That was a big statement, so we'll see how this evolves. And it is based on the hope that the Fed will be forced to cut big, and that can keep stocks higher. But we have good jobs because tariffs have been announced now, but also investments, things like that. Everything was still good till this quarter. Now it seems like investments will be frozen, new business activity, new hiring, everything frozen, and then we'll see. But this might take a while, so we might still see a lot of news, interesting news in the next months. And the Fed said also they are not in a hurry to act. Now, the next scenario is the intermediate scenario where a recession comes and then the market also goes lower. Businesses hate uncertainty. Consumers have seen their portfolios drop 20%. They will freeze spending. They are now afraid of getting laid off. Thus, they are pausing spending, saving a little bit. A recession is inevitable, and therefore everything needs to readjust to the new situation. And let's look at the US gross domestic product, and you can see everything looked great for the last 16 years, and especially here we had a boom on the money printing and everything. I think that as we haven't had a real recession since 2009, a normal 6-month, 9-month recession is just overdue, no matter taxes, no matter anything. You can push it, you can try it, but at some point it was supposed to happen. So if we have a recession, maybe at first with some stagflation on tariffs, but that then eases out, the Fed is able to lower it. However, let's say the market earnings stagnate, the P/E ratio on less growth goes to 20, and then we have a market of 4,000 in a recession, around 4,000, still 20% down from where we are now. And this is just a more detailed impact of a recession. So less hiring, thus less people buy Adobe subscriptions, which then leads to lower earnings, which then leads to lower earnings for the S&P 500, and then also lower S&P 500. So this is now the likely scenario. Everyone hopes for the mild scenario. However, recession, as I said, overdue, maybe not this year, maybe next year. However, we are there, everything readjusts a little bit, P ratio of 20, 15, depends on how you look at it, and around 4,000 points. Especially for the US, as I said, as others focus on the rest of the world. Now, the third scenario, an out-of-control scenario. The S&P 500 has dropped fast here, and let's say that the Fed cannot cut rates because of global inflation, and this starts to push on tariffs, and we have stagflation, everything is going down, the rest of the world prints, stimulates the economy, pushes commodity prices higher, the US cannot react despite lower oil tariffs. Tariffs do not help the budget on the tax. There is then an issue with the deficit, with the interest payments. There is a prolonged recession, unemployment goes up, everything looks very ugly, while the Fed cannot really push this lower because of global inflation situations. And then also treasuries go up, and this is crazy. This is just over a few days. Treasuries went from 4.2 to 3.87, then back to 4.2, 4.1. So there is still a pressure also on the government. The dollar might continue to weaken a little bit from this tariff situation. And then let's say earnings, S&P 500 earnings drop to 160, which would be normal in a severe, let's say, recession, times a P ratio of 15, and you are down to 2,500, 400 points in the severe scenario. I hope the bad scenario doesn't materialize, but we have to keep it in mind because 5,000, we are there, 4,000 is not so far away, and then you never know going forward. However, there is still the bonus scenario, 10,000 possible in the next 2 years. Recession, the Fed collapses, they start printing like they did at every hiccup, and they double again the balance sheet. Everyone is flushed with money, inflation is let run 10, 15% over a year or two. This, like it was here, boom, and then everything readjusts. US treasuries try to stay at real returns of 0, and boom, you have a 10,000 stock market in the next year or two on an inflationary situation. That is also possible. When it comes to investing, we have to keep in mind that all these scenarios can happen. Someone would now attach, this is the probability, this is the probability. That's completely wrong. My idea is that we have to think, okay, if this happens, how am I affected? If this happens, how am I affected? If a bad scenario happens, how am I affected? If a bonus scenario happens, how am I affected? If you end up well, no matter what happens, then you have a well-structured, value investing, business-oriented ownership portfolio. That is the key when it comes to investing. If you are hit and you don't reach your pension retirement goals in any of these scenarios, that will happen sooner or later over the next 20 years, all of them, then it is a bad situation for you. We, as value investors, will look, okay, mild, dividend, reinvest, build that portfolio, bad also, reinvesting, and then bonus, inflation, if you own value, you will do well. Thanks for watching, I'll see you in the next video.